If you've ever wondered whether choosing Vanguard or Schwab ETFs could save you thousands of dollars over your lifetime, you're about to discover the answer. And by the end of this video, you'll know exactly which one might be quietly draining your money, and which one could leave you with way more in your pocket.
Hi there. Before we dive in, please take a moment to read the full disclaimer on the screen.
Most people pick an ETF based on a quick Google search, or because someone online mentioned it. But tiny details like expense ratios, bid-ask spreads, tax efficiency, and even how the companies themselves operate can make a bigger difference than you think. So if you invest at all, or you plan to start soon, stay with me, because understanding this could literally change the outcome of your financial future. Let's start with something that surprises a lot of new investors. Vanguard and Schwab are both excellent companies, and both offer strong ETF lineups. But they work differently behind the scenes. Vanguard is structured in a unique way where the investors actually own the fund company. That means their incentives are aligned with you. Lower costs, long-term thinking, slow and steady growth. Schwab, on the other hand, is a publicly traded company. They still offer low-cost funds, but their business model is different. They make money in more ways, which sometimes affects how their funds are priced or managed. Neither model is bad, but they often lead to slightly different approaches to ETFs. Now, here's where things get interesting. People love to say the difference between a 0.03% fee and a 0.04% fee is tiny. But what if you invested for 20 years? What if you invested tens or hundreds of thousands of dollars across your lifetime? Those tiny percentages can snowball into thousands of dollars gained or lost. And most people don't even realize it's happening. So ask yourself right now, how would you feel if you discovered that your ETF choice cost you an extra $8,000 over the long run? Would you switch? And would that change how you pick funds in the future? Drop your answer in the comments. I really want to see how you think about this. Let's dig into specific examples because this is where you can clearly see the differences. Take the popular Vanguard Total Stock Market ETF, VTI. It tracks the entire U.S. stock market, over 3,000 companies, and it's known for being extremely tax efficient. It has an incredibly low expense ratio, typically around 0.03%. Schwab's equivalent is SCHB. It's also a total market ETF with a low fee. But depending on the year, the fee might match Vanguard or be slightly higher or lower. Performance-wise, they are usually very close, sometimes identical. But tiny tracking differences can add up over time. Which one would you pick right now based on what you've heard so far? Tell me in the comments. I'm curious whether people prefer Vanguard's structure or Schwab's pricing. Another popular matchup, S&P 500 ETFs. Vanguard's VOO versus Schwab's SCHX or SCHX versus VOO, depending on category comparisons. VOO tracks the S&P 500 with a famously low cost. Schwab's similar funds also track large-cap U.S. stocks with low fees. Over time, their performance tends to be almost the same. But here's something most investors never consider: liquidity and bid-ask spreads. Vanguard ETFs tend to have extremely high trading volume, which often makes spreads slightly tighter. That means when you buy or sell, you lose less money to the difference between the buy and sell price. It's tiny every time, but again, it adds up over your lifetime. And this brings us to the question, is it better to pay slightly lower fees, or is it more important to have higher liquidity? Which one matters more to you personally? If you could only choose one, what would you pick? Let me know in the comments. I want to see if more investors think long-term or short-term. But it gets even deeper. Vanguard uses a special share class structure that helps keep capital gains taxes extremely low. This structure has been a huge advantage for Vanguard ETFs for years. Schwab ETFs are also generally tax efficient, but they don't have this exact structure. The difference doesn't show up every year, but when it does, it can be meaningful. Imagine two funds with almost identical performance, but one triggers a small capital gains distribution and the other doesn't. Over decades, that difference compounds. Now, before we go further, If you're enjoying this breakdown so far and you want more helpful financial videos that make investing easy to understand, tap the like button, subscribe, and share this video with someone who invests. It really helps the channel grow, and it also helps me bring you more content like this. And while you're at it, answer this. What's the biggest challenge you face when choosing ETFs? Leave your answer in the comments. I read as many as I can. Let's talk about something very important. Schwab often markets its funds as the lowest cost option, but Vanguard's long-term performance, tax structure, and investor-owned model sometimes outweigh those tiny fee differences. For example, if Vanguard's ETF outperforms Schwab's by just 0.03% per year due to slightly better tracking or fewer realized capital gains, over a 30-year period, someone investing $500 per month could end up with thousands more. And the crazy thing is that most investors never even notice where that extra money came from. On the flip side, Schwab sometimes wins in convenience. Many people prefer Schwab's brokerage platform for its simplicity. If you already invest with Schwab, buying their ETFs can make your experience smoother. And for new investors, sometimes convenience matters just as much as cost. So ask yourself, do you prioritize performance and structure, or convenience and simplicity? Which one feels more important to you in the long run? Tell me in the comment section because I'm genuinely curious what matters more to people. Now let's talk about the emotional side of investing. Some people feel more trust with Vanguard because of their investor-owned structure. Others feel Schwab has better customer service and better online tools. Some prefer the brand that feels more serious, and others prefer the one that feels more comfortable. And believe it or not, these feelings absolutely influence investment choices. But are they worth thousands of dollars in potential long-term gains? Would you choose a platform based on how it feels, or based strictly on the numbers? Drop your thoughts below. One big factor many investors overlook is tracking error. Even if two ETFs say they track the same index, some follow it more accurately than others. Vanguard is known for extremely tight tracking. Schwab is good, but occasionally has slightly more variation depending on the fund. Does this matter? Over long periods, yes. Tracking error can either boost your returns or reduce them. And it's not always predictable. This is why looking beyond just the name of the ETF is so important. Another thing to consider is dividend reinvestment. Both companies offer it, but the timing and efficiency can differ slightly. Again, little things matter when compounded over decades. Even the way each company lends securities behind the scenes can subtly affect returns. Now here's a thought-provoking question for you. If two ETFs have almost identical performance, but one is from a company that reinvests profits into lowering costs for investors, while the other is from a company that reinvests profits into growing their business, which one aligns more with your values? Tell me your answer in the comments. This is always a fascinating discussion. Let's talk practical money. If you had $10,000 invested for 30 years earning an average 7% return, the difference between a 0.03% fee and a 0.06% fee might be around a couple $100. Not much. But if you invest consistently, say $500 per month, the difference can reach into the thousands. And if you start investing early, even more. Fees matter most to people who invest long-term and invest heavily. So if you're planning to build real long-term wealth, tiny differences in ETFs absolutely matter. But here's something most people never ask. What type of investor are you? Are you someone who picks one ETF and leaves it alone for 20 years? Are you someone who checks your portfolio every week? Or someone who changes strategies every 6 months? Your behavior can matter more than the ETF itself. For example, if you constantly switch funds looking for the best one, you might lose more money to emotional decisions than you save in fees. So be honest. How do you handle your investments right now? And how do you want to handle them moving forward? Let me know below. So, which one actually saves you thousands? Vanguard or Schwab? Here's the truth, and most people won't like this answer. The difference depends entirely on the specific ETF, the time period, your tax situation, and how much you invest. But if you forced me to choose a long-term winner for most investors, ignoring personal preference and focusing only on long-term structure, tax efficiency, and historical tracking accuracy, Vanguard tends to edge ahead, not always by a huge amount and not with every ETF, but enough over decades to matter. And that's what long-term investing is all about, small advantages multiplied over long periods. But here's the twist. If you prefer Schwab's platform, or you want everything in one place, or you value convenience above the tiny long-term differences, Schwab ETFs are still an excellent choice. They won't ruin your financial future. In fact, they might help you stay consistent and disciplined, which is far more important than obsessing over decimals. So after everything you've heard, which one would you pick for your long-term portfolio? Vanguard or Schwab? Or would you use both? Drop your answer in the comments section. I want to see which one wins in the real world. And if you enjoyed this video and want more content that makes investing easy, remember to like, subscribe, and share this video with someone who needs it. Your support helps me make more videos that empower people to understand their money and build a better financial future.